We're jumping straight into energy fuels today. Everyone is watching the price action, but the real story is the transition from a pure uranium play to a critical minerals empire.
Exactly. You're tuned into the Easy Money Show where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds, and trust me, there are some very profitable and potentially dangerous weeds to get into today, make sure you subscribe and hit that like button.
It really helps.
We're here to help you find the signal in the noise, and today, that signal is coming from one of the most interesting tickers on the board.
It really is. Energy Fuels has been grabbing headlines left and right. The stock has been, well, ripping, up about 15% in the first trading session of 2026 alone.
Right, but let's zoom out a bit. Despite that pop, it's still significantly below its 52-week high of around $27.
A long way off.
So the question on every investor's mind is this a genuine breakout, or is this a classic bull trap? To answer that, you have to look past the daily chart.
You really do.
You have to understand two massive structural shifts happening inside the company. Record uranium production and a billion-dollar high-stakes bet on rare earth elements.
And that's the real tension here. You have the legacy business uranium, which is just firing on all cylinders. That's the cash cow. And then you have this new venture rare earths, which is effectively a startup inside a mature mining company. It's a hybrid model.
Let's break that down, starting with the cash cow, the core business. This is, first and foremost, a uranium miner.
Right.
And if you look at the operational side for 2025, they didn't just meet goals, they crushed them. We're talking about operational excellence with a capital O.
Numbers really back that up. In 2025, they mined over 1.6 million pounds of uranium.
Wow.
That didn't just meet their guidance. It beat the top end of their guidance by 11%. Now, for anyone who follows mining, you know how incredibly rare that is.
It's almost unheard of. Usually mining earnings calls are an exercise in creative excuses. You hear about weather delays, lower ore grades, equipment failures.
Labor strikes, exactly. It's a difficult business. So beating guidance by double digits is a serious statement of intent.
It tells you the engineering team and the geology team are completely in sync. They have their act together underground.
But digging the rocks out is only half the battle. In the uranium game, and really in any critical mineral, the real bottleneck isn't usually the mine itself.
It's the processing, it's the mill.
Right, and this is where the economic moat comes in. We have to talk about the White Mesa Mill in Utah.
The crown jewel.
It really is. For those who aren't familiar with the U.S. nuclear fuel cycle, this facility is it. It is the only conventional uranium mill operating in the United States today.
Think about that for a second. The only one.
In a country that operates the largest fleet of nuclear reactors in the world, there is exactly one place to process conventional uranium ore.
So it's a strategic choke point.
A massive one. If you want to process uranium ore in the U.S. conventionally, you pretty much have to go through Energy Fuels. That creates a huge barrier to entry for any competitor.
You can't just build one of these mills overnight, can you?
Oh, not even close. It's the cost, sure, but it's mostly the regulatory environment.
Red tape.
Between NRC regulations, environmental permitting, NEPA reviews, local opposition, you'd likely take a decade and hundreds of millions of dollars before you even pour the first yard of concrete.
So Energy Fuels effectively has a monopoly on conventional processing. It's an irreplaceable asset.
It is. And because they own the mill, they control their own destiny in a way that other miners just don't. They aren't at the mercy of a toll processor.
They are the processor.
And that control translates to cash flow visibility. They haven't just been mining this stuff and hoping to sell it on the spot market.
Right.
They've been smart. They've locked in long-term sales contracts with major U.S. nuclear utilities extending all the way to 2032.
That's a key detail. This isn't speculative revenue based on where the spot price might be next week. This is secured.
It's locked in. In a volatile commodity market, having contracts signed and delivered 7 years out gives you a floor. It lets management sleep at night.
And it should let shareholders sleep a bit better, too. It creates a baseline of survival. The lights stay on because the checks are guaranteed.
But here's where the narrative shifts. If Energy Fuels was just a uranium miner with a good mill, it would be a solid, perhaps slightly boring, utility-adjacent play.
But they aren't settling for boring. They are pivoting. They were attempting to bolt on a second growth engine that could effectively double the size of the company.
Rare earth elements.
Exactly. This is the blue sky scenario.
Yeah.
This is what has the retail investors, foaming at the mouth.
It's the aggressive play. They're all trying to build a supply chain that is completely independent of China.
And let's be clear about the context. China currently controls something like 80% to 90% of the global rare earth processing capacity.
It's a stranglehold. Energy Fuels is stepping up and saying, we can break that monopoly.
And they aren't just talking about it, they are making massive moves with real capital. First, let's talk about the Vara Mada project in Madagascar.
The numbers there are just staggering. We're talking about an after-tax net present value, or NTV, of $1.8 billion.
Okay, let's just clarify for our listeners who don't spend their days in Excel sheets. NPV is essentially the total value of all future cash flows from the project, discounted back to today's dollars.
So the paper value of this project alone is nearly $2 billion.
Which is huge. And it has a projected mine life of 38 years.
A generational asset. It's not a mine that runs dry in a decade. It produces monazite sands, which are rich in the specific magnetic rare earths needed for EVs and wind turbines.
But owning a mine in Madagascar is one thing. Getting the product to a usable state is another.
Right. And that's why the second move is so critical. They just announced the acquisition of ASM Australian Strategic Materials for $299 million. This isn't just buying another mine.
It's buying a capability.
It creates a mine-to-metal chain. This is the holy grail in critical minerals.
Because normally, Western miners just dig up the dirt and then sell the concentrate to China for processing, right?
Exactly, which completely defeats the purpose of energy security or supply chain independence. If you dig it up in Australia but have to ship it to China for refining, you haven't solved the problem.
Not at all. But with the ASM deal, Energy Fuels is linking mining in Australia, processing in Korea, and finishing in the U.S.
It links everything together. It's a cohesive chain that bypasses the Chinese supply chain entirely.
And that connects the dots to why the market is so excited. It's the convergence of the two hottest macro trends right now.
The AI energy trade and the EV trade.
It's the perfect storm of demand. On one side, you have data centers for AI. They are incredibly power hungry, and they need baseload power.
Power that runs 204/7.
Exactly. That means nuclear. That's the uranium side of the business.
And on the other side,
You have the hardware, electric vehicles, wind turbines, robotics, defense tech. They all rely on permanent magnets.
made from neodymium and praseodymium.
The rare earth side. So Energy Fuels is positioning itself as the Department of Defense's favorite miner by securing domestic supply chains for both of these critical sectors simultaneously.
You can see the strategy so clearly. They are trying to be the one-stop shop for critical minerals in the West.
And financially, they are actually in a position to pull it off.
Right.
Unlike a lot of junior miners who are surviving on credit lines in hope.
Right. Energy Fuels has a fortress balance sheet.
That is a huge differentiator. They have practically no long-term debt and nearly $300 million in working capital.
Again, for the uninitiated, working capital is basically the cash and liquid assets available to run the day-to-day operations.
And in mining, which is so capital intensive.
You're constantly fixing trucks, buying fuel, paying crews. Having a $300 million buffer is massive. It means they don't have to dilute shareholders every 6 months just to keep the lights on.
They're funding this massive expansion, the acquisitions, the mill upgrades, without stressing the company's solvency.
So let's recap the bull case. You have record uranium production, a unique monopoly on milling in the U.S., secured long-term contracts, and a massive new growth vertical in rare earths.
All backed by a pile of cash and zero debt. It sounds perfect.
Almost too perfect.
Yeah.
And that's usually when you need to check your wallet. Because in the markets, when a story sounds this good, the price usually reflects it.
Right. The perfect narrative is expensive. While the story sounds incredible, the valuation is, let's call it demanding.
Demanding is a polite way to put it. Let's talk about the sticker shock. The stock currently trades at a price-to-sales multiple of over 40x.
Whoa, 40. Let's put that in context.
For context, the industry average for a producing miner is closer to 4x or 5x.
So you are paying a 10x premium compared to their peers. You're essentially paying a software company multiple for a company that digs rocks out of the ground.
That is a massive amount of optimism baked into the price. Investors are pricing this as if the rare earth execution is a done deal.
They are paying today for growth that hasn't actually happened yet.
And it's definitely not a done deal. I mean, if you look under the hood, there are some ugly numbers lurking in the recent financials.
Okay.
Look at Q3 2025. Gross margins collapse. They went from a healthy 54% all the way down to 28%.
Ouch. It's a painful drop. Over half their margin evaporated in a single quarter. Why?
It comes down to inventory accounting. They sold higher cost inventory, which caused their cost of sales to spike nearly 600%.
So they were working through a backlog of expensive dirt, basically.
Essentially. Now, management says this is temporary. They claim they're moving to lower cost ore from the Pinyon Plain mine, which is much higher grade.
And that should fix the margins.
Should being the operative word. But the market hates shrinking margins. If that number doesn't bounce back, that 40x sales multiple is going to look insane.
You can't justify a premium valuation with commodity margins that are shrinking.
You just can't. And then there's the skepticism around the rare earths themselves. Right now, rare earth elements contribute very little to the actual bottom line. It's all potential.
This is the show me problem. Roth Capital, for instance, is dissenting hard here. They maintain a price target of $11.50.
Which is roughly half the current trading price. That is a massive disconnect.
Right. They argue the stock is overvalued based on unproven economics. They're basically saying, great story, but show me the money.
And let's be honest, rare earth processing is notoriously difficult. The chemistry is incredibly complex. There is a reason China dominates this. It took them decades to master the efficiency.
And Energy Fuels is trying to replicate that success in a fraction of the time, while executing in less than ideal locations.
Right. The new massive project is in Madagascar.
Not exactly Kansas.
No. Madagascar has a history of political instability. Projects get suspended, permits get delayed, tax codes change overnight.
Building a mine there is exponentially harder than operating in Utah. There is significant geopolitical risk there that I think it's glossed over in the glossy investor presentations.
It's not just politics, it's infrastructure. Roads, ports, power. You often have to build everything yourself.
And even if the mine works, you have the integration risk. Integrating a Korean processing plant with Australian mines and U.S. finishing, that is a logistical nightmare.
It's a complex web. You're moving radioactive material across international borders, dealing with 3 different regulatory regimes.
Shipping costs, insurance.
Exactly. If they stumble on the integration, if costs run over, that premium valuation could collapse. The market is pricing in perfection, but the operational reality is messy.
So you have a pristine balance sheet and a great narrative fighting against sky-high valuations and huge execution risks. What are the triggers? What should we be watching?
There are a few immediate ones that investors need to circle on their calendars. First up, earnings.
Q4 and full-year results, late February or early March.
And we aren't just looking at the headline revenue number. We need to see the margins.
100%. Management claims the new Pinyon Plain mine is going to fix the margin issue. Investors need to see proof. We need to see gross margins climbing back toward 50%.
If they come in at 30% again, the narrative that it was just temporary falls apart and the stock is going to get punished.
Then there are the project milestones.
Yeah.
We need to keep an eye on the final investment decision, or FID, for the Vara Mada project.
That's the green light. FID is when the board formally says, yes, we have the money, we have the permits, start pouring concrete.
If they announce financing is secured and they're pushing the button, that unlocks that $1.8 billion value we talked about.
Conversely, if that decision gets delayed, the market will get very nervous.
And don't forget the ASM deal. There is a shareholder vote coming up in June 2026.
Right. That vote closes the loop on the rare earth strategy. If shareholders balk, the whole mine-to-metal story takes a serious hit.
Finally, we should watch the policy landscape. The U.S. Department of Energy has announced a $2.7 billion investment in enrichment.
A huge pot of money. The question is, does any of it flow to Energy Fuels, either directly or indirectly?
If they get a slice of that pie, that's a massive tailwind. Government funding is non-dilutive capital, the best kind.
So bringing it all together, what's the synthesis here?
How should an investor categorize this trade?
Well, looking at the trade structure, you are essentially buying a company that is currently a uranium leader with a massive call option on becoming a rare earth giant.
That's a good way to frame it. You're paying for the uranium business, but you're paying a premium for the chance that they become the biggest rare earth producer outside of China.
Exactly. If they pull it off, if they navigate Madagascar and integrate ASM, it's a multi-bagger. The 40x multiple will look cheap in hindsight.
But if they don't, if the rare earths get bogged down in politics or technical issues,
then you are holding a very expensive uranium miner with compressing margins. And that $11.50 target from Roth Capital is a sobering reminder of where the floor might be.
more than a 50% haircut from here. So the question isn't just about commodity prices anymore. It's about whether you believe Energy Fuels can effectively become the Western Hemisphere's answer to China's rare earth dominance. If yes, the premium is worth it.
If no, look out below.
It's a high-stakes bet on execution. All right, that's the lowdown on energy fuels. Remember, we are looking at the data, but you need to verify it yourself. Do your own homework.
Thanks for tuning in.
We'll catch you on the next one.